So at Shell, we've been involved in developing LNG to power now in a number of continents, from India to Mexico, and like Total, we've invested in port infrastructure, and of course we're partners in the Hazira terminal in India, which I spent about 4 years of my life working on. And that shows how companies such as ourselves will invest to actually facilitate that. But I think it's already been said as well about changing business models. As a company, we've actually taken steps around smaller scale LNG. We have a business up in Norway where we actually distribute LNG in parcel sizes of ships down to 1,000 cubic meters. It's less than 1% of a typical LNG, 0.5% of a typical LNG cargo, and trucking LNG to smaller scale. China trucks LNG around and moves around 10 million tons of LNG by trucking to off-grid solutions. And so I think that will also play a role in the development of power in Africa as well. And so this openness to explore different models, to leverage some of that experience is important. And we're already developing small gas-to-power value chains in places such as Gibraltar, on scales of sort of 50, 60 megawatts, and bringing LNG into that. So LNG can play a role there, and LNG can also play a role in actually developing gas markets ahead of actually bringing on some of these large-scale reserves. If you put it into context, bringing on one LNG train at baseload is equivalent of fueling about 5 gigawatts of power. Now, in many countries, that is several times what the installed power base actually is, and it's going to take time to get there. And actually, it's easier to bring LNG into smaller quantities to begin to develop that market ahead of actually larger scale development, offshore development, to bring that gas on shore. So we believe that LNG has got a very important role in Africa's gas future.
Thank you, Chris. Interesting. So speaking of different business models, let's move to Nicholas from Aggreko.
Thanks, Jonathan. We've been the gas to power with Aggreko for about 10 years now. We started our first gas power plant in Tanzania, 50 megawatt gas power plant in 2006. And since that, the trend on demand of gas to power in Africa, we've seen that growing a lot. Now we're reaching about half of our gas production, of our energy production in Africa is coming from gas. From very small power plants, like we have in Egypt to replace gas flaring, 2 to 3, 4 megawatts, which deliver power in the community, local community, to mid-size, large-size power plant like we have in Mozambique, in Rezano Garcia. It's a cross-border power plant using the gas from Mozambique and delivering power to Eskom in South Africa, to Zambia, to Namibia. And this power plant has been able to adapt upon the quantity of gas coming from Mozambique. So we started 200 megawatts, we went to 200 megawatts, and also on the demand of electricity requested from EDM or Eskom. Another example is what we're doing in Abidjan, 200 megawatts, using the gas coming from Abidjan, produced in Senegal, in Ivory Coast, sorry. So for us, the prime priority is really using what Africa is producing in terms of gas. This makes the cost of kilowatt-hour low. And I like to say large is beautiful with LNG, FSRU, but also small-scale power plant is nice and what it is needed in Africa. Last point I'd like to touch is also the technology in power generation, which makes the cost of kilowatt-hour reduced. In Aggreko, we like to invest in our fleet to improve the efficiency of our fleet, but we also look for new alternatives. And recently, we have a partnership now with Jen Baker for better and more efficient gas engines. Lastly, I like to insist on the fact that Africa is producing gas, and monetizing the gas from Africa is a challenge and it's key. And as an example, we're doing in Senegal, for the largest cement plant in Senegal, which is Socosim. We're using the gas produced very locally to produce 10 megawatts, which is used for the industry of Senegal for the cement plant. And this is a full integrated gas to power generation solution, which make really the cost of kilowatt hour very low, which is a big point in Africa.
Nicholas, thanks.
So, do you mind? Yeah.
Yeah, please.
I think it's very interesting, again, the different models. And if you look around all of the other places where gas to power is being done, you look in Myanmar, you look in Bangladesh, you look in Pakistan, and the same type, what's right in South Africa won't be right in Cameroon or Senegal or other markets. Africa is lucky in that it has a lot of closely located gas. It's also lucky in that there are opportunities to import gas. So if you're looking at Myanmar will build a large onshore regasification complex. Probably in Pakistan it'll be offshore floating. And I think within Africa all of those models are possible. In some places, clearly South Africa has very large ambitions to, as Kishore was saying, to gasify the economy, and there are terrific opportunities to make really large changes to the South African economy around gas. But what might be right in West Africa, where there's offshore gas already, is a pipe. So we're working at the moment in Ghana with Vitol on their project. In that case, it's a much simpler project. They have a lot of gas under the seabed, and a pipe to the onshore is clearly the most sensible option. And there are other countries, you look all up and down the coast of West Africa, where there are either pipe opportunities or perhaps short sail LNG regasification opportunities as well. So I think what we were talking before the discussion, there are lots of different models that will all be right for different parts within Africa, and what is bankable in South Africa will be completely unbankable from a financing perspective in other parts of the continent. You will not be able to do the same type of scheme that South Africa is capable of pulling off in economies that are a 15th of the size of that. And so all of the models and all of the potential players, from the very big players who are sitting here at the table to the IPP developers, to Globalec and to Agreco, all of those models are going to have a place, I would think, in sub-Saharan Africa in the same way that they are in South Asia and Southeast Asia and the Pacific and other places at the moment.
Thanks, Martin. Just a couple minutes from Globalec's perspective and the perspective of an IPP. It's a tremendous time in this market to be a buyer of LNG and gas. And whenever I talk to the stakeholders in South Africa and the IPP office, I always urge them, get this program out so that we can procure the LNG while it's a buyer's market. And I think there are a couple real exciting drivers that are changing the business model. And from the LNG supply side, right, Tom touched upon it. You have a low price market and you have an oversupply. And it's great to see the innovativeness that results from the business challenges that these big players face. For me, as an IPP developer, it's an extremely exciting time also to think of there's smaller stuff that we could do. Maybe there's gas to power plays that work to move across the continent and do the 50 to 200 megawatt type projects. And I think that's going to be a question after Lucy speaks, when we open it up, around what's going on in China that they can truck, that volume of gas. What is the enabling factor that will allow smaller LNG deliveries into Africa? My own view is that part of it is South Africa. You land big LNG here, becomes part of the supply line, and then it's easier to do things along the coast from there. But I'm going to ask the experts. From the IPP perspective, we really see that the most exciting play for us to grow our business over the coming years is going to be gas to power, right? And also the interesting interplay with renewables that a couple of the speakers touched upon. That's something that I think as we look at the evolving business models, whoever can really line that up in the most efficient, cost-effective manner, quickest to delivery, who can read and understand what a system needs and be able to respond to it. It's those players who are going to be the winners going forward in evolving new models. Let me hand it over to Lucy from DBSA, who's going to talk to us a little bit about some of the perspectives of a lender in the gas-to-power business.
Okay, thanks, Jonathan. So I think the first thing I wanted to say is I agree fully with what Mr. Nambarete has said, that we need to find a combination of different parties. Traditionally, most of the projects have been financed through project finance. I think that's under the Renewable Energy Program. But in order for this to work, there are various parts and pieces of the puzzle that have to come together. We have DFIs that have to come to the party in order to look after issues around infrastructure, because they have a natural mandate to develop that, including the DBSA. Then we've got other funds that look after projects in the early phase, and that's not necessarily a place where a commercial bank would traditionally play. So we've got those parties that would then participate in a different level of the infrastructure value chain. So if we look at it differently and not in the traditional sense where we have almost one size fits all, and try to marry various pots, various pockets of funding, then it's possible to get the capital that would be required in order to bring this to the fore. I think the Honorable Nambarete also talked about the considerations for bankability to some extent. I think one of the key issues around the regulatory and legal, regardless of which country you are in, the lender and the investor will want to see that that's clear, that the procurement framework is in place and it is above board. Secondly, there needs to be a complete understanding about the tariff regime, and it needs to be able to withstand. I think one of the issues that affects the bankability in certain instances is that the lender is not quite clear whether this is going to last for the next 20 years, whether there'll be any issues that might make the PPA no longer stand. So the sanctity of that particular tariff regime has to be clear. And I'll talk to something that Jonathan asked me to allude to later. The issues around the contracting regime, various parties are involved and they need to be quite comfortable. Government support and commitment is paramount, it's supreme. Most of the parties here will agree to that, and that's one of the key fundamental criteria. One of the key issues that has come up, and it came up yesterday as well in the South African session, is around the currency considerations. In order for this to work, there will need to be some discussion around how to bring in foreign currency elements without, of course, creating significant strain. And that's a discussion that I understand is still underway within the various circles that need be. Because the renewable energy program, as it were, was primarily financed through RANs, just very little in terms of other foreign sources. But the debt was primarily RAND financed. And in order to develop this gas program at scale, there needs to be a discussion in terms of how to bring in other players, and that would be the international players, in order to create the scale that is perhaps considered. I'm from a DFI, so development impact is key for us. We want to see local players involved. We want to see that those parties have actually they have a view in the project, because that brings about the sustainability. Without that win-win situation, the project becomes unsustainable and could actually jeopardize the whole bankability of the project. So we are keen to see that, and I think it assists in terms of ensuring that that is clear. And issues around local economic development, how to develop that in a sustainable way without, of course, burdening the other aspects of the program too much. So those are just some of the few things that I would like to say. But key in terms of bringing the various parties across the value chain and combining the various players, because they bring various strengths. For example, in the renewable energy program now, we see a lot of institutional investors. Now that construction is complete, the projects have been de-risked, they are interested in participating in the program. So it's about thinking holistically about the program and the funding and how best to make it work. Thank you.
Thanks, Lucy. Martin.
Yeah, thank you, Lucy. It was excellent. One of the key things, and obviously at one level I'm stating the obvious here, is in order to finance a project like this, there needs to be a cash flow at the end of the stream which supports everything that's happening upstream. Now, it might be slightly different if you have Shell or Total at the table. You have a large balance sheet, and you can slightly alter the economic analysis, but for an ordinary project financing, there needs to be a cash flow at the end of the stream from a creditworthy purchaser. And what we're looking at in many cases with the gas to power chain is a lot of investment upstream, midstream of the power station. And the question, of course, is whether the power off-taker can generate sufficient revenue in order to satisfy the debt that will exist for the whole chain. So one of the things to think about, and it's happening in all of the countries, is what the project looks like, how much of the value chain and how far upstream you call your gas to power project, whether it's integrated all the way back up to the upstream, which you might do when you're looking at the players of the caliber we have here, or whether it's much more a gas purchase or an LNG regas play with a power station attached to it. And there are a lot of considerations, industrialisation and other use of gas. And of course, key to this as well is the creditworthiness of the off-taker. In some countries, that won't be an issue. In other countries, clearly there'll be need for guarantees and credit support to provide the certainty that even DFI lenders will need. So there are, again, I think it's coming back to the theme that everyone's talked about, a lot of different solutions in different scenarios. You'll end up with a project which is fully integrated, and in other places you might end up with a project that really involves purchase of gas and power generation. In other cases, you'll go all the way back up to the upstream because you'll have Shell or Total at the table. And I think what's bankable for a gas to power project in Africa, there are probably about 5 or 6 different answers to that. Not all of them will be bankable in all the jurisdictions. You've got to pick the right piece of the puzzle for the right puzzle that you're working on. And that's sort of the point Lucy was making as well, I think.
Thanks, Martin.
Yeah.
Thanks for that. I'm going to open it up for questions from the floor to involve people. While people think of their questions, I've got a couple right here, and then we'll come to Salvador in just a minute, if that's okay. The 2 questions I had were for the big portfolio suppliers, and along the theme of shifting business models. And Chris, you talked about the potential for smaller deliveries. What has to happen to enable those smaller deliveries so that we could realize those types of opportunities in different parts of Africa? That's the first question. Then Tom, I'm going to come to you around the gas to power, gas and solar, gas and renewables integration, and how you see that business model moving forward. But Chris, go.
Okay. Yeah, so looking at the small scale, and as I mentioned earlier, we've been doing this in Norway for a number of years now, and more recently looking into the Western Mediterranean. I think what's quite important is to take a whole value chain perspective. I think there's a lot of ideas there of sort of elements of small-scale terminals or small-scale ship. It is very important to take that fully integrated view over the value chain to make that work, and to make it work understanding what the competitive fuel is. I mean, I think one of the things to sort of recognize, Africa burns a lot of distillate. You're burning a lot of diesel and quite expensive, and power costs are expensive. And when you start looking at that opportunity of smaller scale LNG against that, it has an advantage there. I think a second element is understanding the existing infrastructure and how you can actually leverage off some of that infrastructure as well. One of the things which I think is always challenging when, even also true on the larger scale, people often talk about an FSRU, but also forget at times you need to invest in breakwaters, dredging, jetties, port facilities. The FSRU is actually just part of it. Part of actually what's going to be important in unlocking small scale is to be able to leverage some of those existing facilities. So you're not having to bear all of those civil and infrastructure costs there as well. I think the other element, and won't steal Tom's thunder, but working closely with those customers to understand. I think I've probably just lost the microphone. Understanding the needs on the power dispatch, etc. How that may actually play out with renewables as well, I think is going to be an increasing element there. That's I focused on shipping, on trucking. I mentioned China earlier. One of the challenges is going to be, again, a story of infrastructure. Roads is going to be a key issue for actually moving, if LNG is going to play a role or more distributed there. I was being told a story recently by a big fertilizer producer, where actually, if fertilizer gets landed at X, the delivered cost to a farmer a little way inland is 3X. Now, LNG can't bear that, so understanding how you build those logistic chains is going to be what is necessary, I think, to begin to see trucked LNG come into distributed power. But it has that potential there, because it is already happening in terms of displacement of diesel into the transport sector.
Thank you, Chris. Tom.
Well, I think those points are really well made on small-scale redeliveries of LNG that perhaps might serve, for example, the smaller power plants, the smaller LNG to power projects in Africa. There's some really important smaller projects that are waiting in the wings that would suit redeliveries in smaller quantities. The challenge is that it all ends up in the price of the kilowatt hours, and if the the economies of scale aren't there, it translates into higher price kilowatt hours, and so the challenge or the responsibility of the industry is to try to reduce the costs, and I think we're not there yet. We perhaps aren't as far forward as we should be, but those the technology is there. There's an awful lot. Some of them are in the conference hall or exhibitor hall. There's a lot of resources going into trying to innovate in the space of smaller deliveries, which will suit those smaller power facilities. There still needs to be more cost come out of that chain to make those 200, 300, 400 megawatt projects really competitive, so that the buyers of those kilowatt hours in those locations are not disadvantaged, or their industries aren't disadvantaged. So that's on the small-scale ship redeliveries. On the LNG trucking redeliveries, I think we will see some projects emerge in the next 5 to 7 years where having the LNG onshore where the LNG is being regasified onshore rather than regasified on the ship. We'll see some liquid onshore. We'll start to see some distribution of that liquid, but safety is going to be the primary concern. And then again, the cost. How far can you really get from that facility? But certainly, when one looks at the industry leaders on that, ENN in China, for example, extremely impressive portfolio of rolling out. I think Chris might have mentioned the figures, but some amazing numbers of 2 million tons per year of LNG trucked in China. It's all possible.
Thanks, Tom. Salvador, I know you had a comment.
Thank you.
And we'll go to the
just
audience.
Just before we pass to the audience, I just wanted to comment on one of the issues that Lucy mentioned, the issue of tariff regime. In our part of the world and African continent, the levels of access to electricity are very, very low, and there's a pressure to provide social energy to those communities. So I think the solution to that is to establish a separation between what is commercial energy and social energy, and make sure that the commercial energy is supplied by commercial firms, and the social energy is supplied by other entities. It could be enterprise or other